All right, let's get into it. Today, we're putting on our detective hats. We're going to learn how to look at any company and see what's really going on behind the scenes by cracking its financial code.
I mean, this is the big question, right? You see a company making headlines, you hear all the buzz, but how do you cut through that noise? How can you actually tell if a business is a star performer or if it's, quietly heading for a cliff?
Well, the good news is you don't need a crystal ball or any kind of magic. You just need the right framework, a set of tools to help you sift through the evidence. So in this explainer, we're going to build that financial detective's toolkit for you piece by piece. Let's get started with the absolute basics. Every great investigation starts with gathering those first initial clues. And these are the fundamental techniques that are going to let us see where a company has been and give us some pretty strong hints about where it might be going.
Okay, tool number 1, comparative analysis. Now, the idea here is super simple. You're basically just putting 2 years of financial statements right next to each other. Think of it like one of those before and after photos. All we're doing is looking for what changed, what got bigger, what got smaller.
So let's look at this company, ABCL Limited. A few clues just pop right off the page. Their long-term borrowings dropped by over 6%. That's a good sign, right? They're paying down their debt. But whoa, hold on, look at this. Other non-current assets jumped by over 200%. A detective's first question is always, what on earth did they buy? And at the same time, their inventory of finished goods fell by 26%. So, are they just selling stuff way faster, or are they making less of it? See? These are the little threads we need to start pulling on.
Okay, next tool in the kit, common size analysis. Now, if the last tool was a before and after photo, think of this one as the company's blueprint. We take every single line item and we show it as a percentage of a bigger number, usually total assets. What this does is it reveals the company's internal structure, what its most important parts really are.
And right away, we can see how this company's blueprint is changing. In 2020, you can see that plant and equipment and their finished goods were almost equal slices of the pie, both around 35%. But fast forward to 2021, plant and equipment has grown to over 42% of all their assets, while inventory has shrunk way down to just 23%. This tells us the company is becoming more asset-heavy. It's relying more on its factories and machines and less on its big stockpile of products.
So a couple of years gives us a snapshot, but to really see the whole movie, we need trend analysis. This is where we look at data over a longer period, say 5 years or more, to spot the big overarching patterns. This isn't just a photo anymore. This is like watching a time-lapse video of the company's entire life.
And the story this time-lapse tells is, well, it's pretty critical. We set 2016 as our starting point, our baseline of 100. By 2020, just look at this massive divergence. Total assets have absolutely skyrocketed to an index of 272. That means they've almost tripled in size. But their sales? They've only just inched up to an index of 124. The company is getting way, way bigger, but it's not generating sales at anywhere near the same speed. For a financial detective, that is a major, major plot twist.
Okay, so we've analyzed our company by itself. But any good detective knows you can't just work in a vacuum. It's time to see how our suspect stacks up against the others. It's time for the police lineup.
This is what we call inter-firm, or cross-sectional analysis. A clue is only really useful when you have something to compare it to, right? We have to look at the company's neighborhood, its industry, to see if its behavior is normal or if it's suspicious.
Now, this lineup from the fertilizer industry in 2020 is fascinating. You've got National Fertilizers, the absolute giant, with over 128 billion rupees in sales. But look at its net profit margin. It's negative. They're actually losing money. Then you have this much smaller player, FACT. Its sales are way lower, but its profit margin is a super healthy 35%. This is a perfect example of how being the biggest doesn't always mean you're the most profitable. Context is everything.
So we've gathered the clues, we've compared our suspect to others in the lineup. Now it's time to go deeper. It's time for the deep dive. We need to understand the motive. Why is the company performing this way? And for that, we bring out a really powerful tool called DuPont analysis.
See, the ultimate goal for pretty much any company is to generate a good return on equity, or ROE. This number tells us exactly how much profit the company makes for every single dollar of shareholders' money that's been invested. For investors, this is the bottom line.
But hey, we're detectives, right? Just knowing the final number isn't good enough for us. Why is the ROE high? Or why is it low? Is it because of brilliant management? Or is something else going on under the hood? We need to deconstruct that number to find the real story.
And this is where the DuPont analysis is so brilliant. It reveals the 3 hidden drivers behind that ROE number: profitability, efficiency, and leverage. Is the company making a ton of profit on each sale? Is it using its assets super efficiently to make those sales? Or is it just using a whole lot of debt to juice its returns? By breaking it down like this, you, as the detective, can pinpoint exactly where a company's strengths or its weaknesses truly lie. All right, time for our most advanced tool. This one isn't just about understanding the past, it's about predicting the future. Think of this as the financial equivalent of a criminal profiler's model.
It's called the Altman Z-score. It was developed way back in the 1960s by a professor named Edward Altman, and this formula has been shockingly accurate for decades. What it does is it takes 5 key financial ratios, gives each one a specific weight, and then combines them all into a single score that predicts the likelihood of a company going bankrupt.
So let's run our profiler on a case. Here we have 2 mystery companies, Firm A and Firm B. Now, just looking at the raw financial ratios, Firm B looks a bit healthier, but it's kind of hard to be sure. So let's feed all this evidence into the Z-score model and see what it spits out.
And the profiler's result for Firm A is 1.77. Okay, so what does that mean? Well, according to Altman's model, any score that falls below 1.81 puts a company squarely in the danger zone. Our profiler has just waved a massive red flag. Firm A is at a high risk of going bankrupt.
And what about Firm B? Its score is 4.80. That is a completely different story. It's way above the 2.99 threshold that signals a safe zone. The model sees this company as financially sound, very healthy. Did you see how the Z-score just cut right through all that confusing data to give us 2 incredibly clear, predictive verdicts? It's powerful stuff. But before we close the case file, every good detective knows that they have to be aware of the limitations of their own methods. No tool is perfect. So it is absolutely crucial to use these tools with a healthy dose of caution. Remember, all of this analysis is based on historical data. It's basically a post-mortem of what has already happened. Plus, no 2 companies are ever perfectly identical for comparison, and something as simple as how a company defines profit can change everything. These tools give us powerful clues, but they are not crystal balls. They point us in the right direction, but they don't give us absolute certainty.
But now you have the toolkit. You have the framework to look past the headlines, to start asking the right questions, to spot the clues, and to piece together the real financial story. So, I guess the only question left is, what company will you investigate first?